Here on the Professional Edge, we are talking about why evaluate your risk. What kind of risks are there? My name's Sean Todd, tax attorney, CPA, and certified financial planner, host here on the Professional Edge. And we're talking about evaluating your risk. Risk in your portfolio, that's number one. Number two, risk of a downside protection. Previous session, we talked about boomer's candy, as it's referred to in our practice. And it basically says this is not an annuity. It is not any lockup for any 9 years, 10 years in your portfolio. We don't stress that in any shape or form. Then we're going to say we're going to cap the upside to a certain percentage, 12% in our example, and cap the downside, and it could be 10%, 15%, 20%. So how does this work? Well, all right, S&P 500 index goes up 18%. Guess what? You're capped at 12. That's all you get. The 6, you're not going to benefit from. But what if the market has a 30% drop? Well, in your portfolio, then you are not going to have to participate in all 30% of that loss. So if you have a 20% downside protection, your portfolio would only lose the extra amount over that 20%. In our example, it's 10%. So your buddies there at the McDonald's breakfast table are looking at you and saying, man, this market is tough. And you say, yeah, it is. And they say, wow, how are you feeling losing 30%? You look them in the eye and say, I haven't lost 30%. I've only lost 10%. And they're going to look at you and say, well, how did you do that? And you will say, I evaluated my risk with the state management counselors, and we put in a plan that A, protects me 20% on the downside. After that, I participate. But I avoided 20%, 66% of the loss by doing this strategy. Well, if you want to have information on that strategy to see if that makes financial sense for you to eliminate some of your investment rate of return risk or market risk, as they refer to, give our office a call at 404-250-9798. That number again, 404-250-9798. So the other thing we talked about was the longevity risk. We got a plan for your retirement earnings and savings to last for 20 years. First generation ever. Guess what? People aren't putting the mathematical decision making to that longevity. They are saying, I'm retired. I think I can spend $6,000 a month. I get some Social Security. I don't qualify for a pension. So I'm going to wing it on my napkin, and I think I'm going to be okay. Well, I would want a little bit more certainty if I was going to retire in, let's say, 3 years, 5 years, or I've just retired. I haven't done the real analysis on making sure that I don't run out of money before I run out of time. That's a worthwhile exercise to go through. And to start that conversation, give our office a call, 404-250-9798. That number again, 404-250-9798. Question might be, hey, I have my 401k. Should I roll that over to a self-directed IRA? I have a little bit of money in my Roth account, and I have some after-tax money. I'm going to get paid out my severance at the end. How do I start this structure? When do I take Social Security? At 62, 66 in 6 months, or wait until I'm 70? Well, the math matters. And we run that on different scenarios and say, okay, what's the effect on your portfolio drawing $6,000 a month if we elect Social Security at age 62? Run the numbers. Then what about the deferral till I'm, quote, fully retired on full retirement age? What does that look like? What's the impact on the portfolio and the numbers and the average balance inside my investment accounts? Let's run the numbers. And then we say, okay, what if we are patient, we use your resources and defer the election to take Social Security until age 70? How does that impact your plan? those are very worthwhile exercises, and a lot of people don't want to sit down and actually spend a little bit of time on their finances, but you would be surprised. Recent report by an insurance company came out and said individuals that work with a financial advisor are 65% confident in their ability to sustain their retirement. That compares with 24% of individuals not working with a financial advisor are uncertain about their wherewithal to be able to sustain their safe and secure retirement. So a 65% versus 24%. That is significantly different. I think I would rather be on that 65% side and not fret over running out of money before I run out of time. So that's why we're evaluating risk in this session of the Professional Edge. So what's the other risk? Well, let's talk about this. You designate the wrong beneficiary on your life insurance or on your 401k or self-directed IRA. So naming the wrong beneficiary, what does that mean, Scene? Well, what that means is you name your spouse. You say, wait a minute, hang on. I've named my spouse. That's what it's going to be. I know my spouse can do a spousal rollover election, not paying tax on it. I don't agree with you, Scene. Well, here's the thing. The risk is your kids could actually be disinherited by a blink of an eye. Here's the scenario. You name your spouse being the primary beneficiary on your $1 million IRA. Unfortunately, you're in a car accident. You pass away. Yes, spouse walks in, death certificate, spousal rollover, no tax consequence. Guess what? Spouse meets H2, and I'm not talking about the Hummer vehicle. I'm talking about H2, husband number 2. They get married. Guess what? Your wife wants to be copacetic with the new husband, and the new husband has this whiz-bang stockbroker, and we're going to use him now. Well, the stockbroker opens up the IRA account for your spouse, your surviving spouse, and guess what? By default, who's going to be named the primary beneficiary? Well, the spouse. That's H2. Guess what? Your spouse only lives 3 years in this new marriage. Boom, they're gone. Kids of this first marriage come in and they say, hey, mom passed, dad worked for the company 30 years, said he had like $1 million. I know mom used a little bit of it, but we're looking, maybe 800,000 should be there for us. Guess what? H2 stockbroker looks him in the eye and says, it's not going to you. It's going to H2 because H2 was a primary beneficiary on that IRA that was rolled over. It's by default. So you say, wait a minute, hang on. That can't be right because the will that mom had said that we get her assets. She left her new H2 a life insurance policy, named the beneficiary, that's fine. But her will says we get all the stuff of mom. Well, guess what? Being a listener here on the Professional Edge, we all know that the beneficiary designation on the IRA supersedes whatever you have within your last will and testament. So, default H2, primary beneficiary. What's the risk? You disinherited your children by naming your spouse as a primary beneficiary on what is most of the time the largest financial asset in any household, the qualified account, the 401k, which is rolled into a self-directed IRA. That's the risk. You could disinherit your kids, and I've seen it time and time again. So how do we address that risk? Well, we don't name an individual to be your primary beneficiary on your IRA account. What we do is we draft, being a tax attorney and understanding risk of loss, well, we integrate your financial plan with your estate plan, And that's the key benefit of working with estate management counselors. We do the estate planning, we do the tax planning, and we do the investment advisory. It is a coordinated approach. Unmatched credentials within the industry. A lot of times stockbrokers are stockbrokers, CPAs are CPAs, and the others, they don't meld together. They don't talk. So let's meld this together. Let's have an integrated wealth plan. So we don't name your spouse as being the primary beneficiary in your IRA. We want them to have access to it, but we do not want H2 to be able to ever get this, or H2's magical stockbroker to create the IRA account form and name the spouse by default as being the primary beneficiary. No, we're not going there. So we're not going to risk disinheriting our own kids. So what we're going to do is we're going to designate a trust as being the primary beneficiary on that IRA. Okay, you say, well, there's just a line. And we say, yeah, that's right. We're going to name the trust as being the primary beneficiary. Now the trust is dispositive of that IRA account, and it goes for the benefit of the surviving spouse. Not a problem. But that surviving spouse can never name H2 as being the primary beneficiary. That is critical, because when your surviving spouse passes away, the trust still controls that IRA account. And it says, give the remaining balance down to my kids in equal shares, 60-40, however you want to split that. But this eliminates the risk of you disinheriting your kids on your largest financial asset, your IRA, your 401k. So if that is not enough to incentivize you to give our office a call at 404-250-9798. That number again, 404-250-9798. I don't know what else could get you motivated to make sure that you do not disinherit your kids on your largest financial asset. That is a risk that we want to address here on the Professional Edge. I appreciate you listening. My name's Sean Todd, tax attorney, CPA, certified financial planner. More coming up on the Professional Edge.
We've all thought about it. Everyone listening will need one. Not having one can cause untold heartache, family conflict escalating to the point of a lawsuit. One simple thing that avoids all that: an effective estate plan. As a practicing tax attorney, Sean Todd with Estate Management Counselors has completed over 1,000 estate plans during his 15 years of professional practice. He can help you implement an effective estate plan, coordinate your financial accounts, and make sure you have named the proper beneficiaries to maximize your tax savings. Call 877-654-9798 today and let tax attorney Sean Todd help you implement an effective estate plan. Call 877-654-9798 today. As a tax attorney, CPA for over 15 years, Sean Todd has implemented over 1,000 individual estate plans. He has recently authored an especially helpful guide, How to Unlock the Ultimate Estate Plan. This guide has helped many individuals to understand the benefits of an estate plan and how to avoid unintended disasters. Sean has made every attempt to write this in plain English. To receive this valuable guide, How to Unlock the Ultimate Estate Plan, call 1-877-654-9798 and request your complimentary copy today, or by emailing your request to info@emcadvisors.net.